Yeah.
Good evening, everyone. A warm welcome to our clients and all our participants to the webinar on macroeconomy and domestic debt market. It gives me great pleasure to have amongst us our eminent speakers, Mr. Navneet Munot and Mr. Abhijit Bhave. Mr. Navneet Munot is the Chief Investment Officer for SBI Fund Management since December 2008. He has over 25 years of rich experience in financial markets. In his role, he is responsible for overseeing investments worth over $100 billion across various asset classes in mutual fund segregated accounts, which makes SBI the largest AMC. In his previous assignment, he was the executive director and head multi-strategy boutique with Morgan Stanley Investment Management. Prior to joining Morgan Stanley, he has worked as chief investment officer for fixed income and hybrid funds at Birla Sun Life Mutual Fund and worked in various areas such as fixed income, equities, and foreign exchange. Navneet is the chairman of Indian Association of Investment Professional, India Society of CFA charter holders with over 3,000 members, and nominee director on the board of SBI Pension Funds. He is a postgraduate in accountancy and business statistics and is a qualified chartered accountant. He is also a charter holder of the CFA Institute and CAIA Institute and has also done his FRM. Mr. Abhijit Bhave, he is the CEO of Karvy Private Wealth. He has an overall experience of over 24 plus years across the wealth management and financial services industry, both in India and overseas. He has worked for organizations such as Deutsche Bank, HSBC, ICICI Bank, and Unit Trust of India in various stints across roles and functions such as business head, sales management, products and channel management, asset and cash management, corporate and retail banking. He is a mechanical engineer and MBA from IIM Lucknow and has also completed CAIIB. I would now invite our moderator for the session, Mr. Shantanu Awasthi, who is the head of products and international business here at Karvy Private Wealth. Shantanu, would want to take your over from here.
Thank you, Survi. Good evening and warm welcome to everyone. And special thanks to our notable speaker, Navneet, for coming on, giving us the opportunity to host him. I would now like to invite Mr. Abhijit Bhave, our CEO, to give you the direction and his thoughts on the matter, and then we'll proceed.
Hi, good evening to our clients in India. Good afternoon to our clients in the Middle East. You know, it's raining a lot in Mumbai, and whenever we used to have an event during rain, we used to say, "Oh no, it's raining, clients won't come." Now when it's raining, we say, "Oh wow, it's raining, clients won't go anywhere, they'll come for the event." So it's good to have rains here. You know, I want to start by saying a big thank you to our clients. You know, we appreciate your time. We sincerely hope that the next 30 minutes to 1 hour that you'll spend with us, we will add value to you. I also want to thank SBI Mutual Fund and Navneet. Today, they are the largest mutual fund in India. They manage 4.25 lakh crores. And Navneet is not just a star fund manager, is also a influence maker, is a thought leader. And I'm very happy to have him here. We were discussing just now, just before the lockdown in March, he had come to our office and met our team. And he was so confident at that time. And now he's slimmer also and still is so confident about the future. So thank you for joining us, Navneet. You know, a lot of things have happened, and today we'll discuss about the economy and the interest rates and credit. Bond yields have gone down. People are printing currency. GDP growth is going down. Credit defaults are happening, and there's moratorium for everybody. And RBI came out with this big financial stability report, casting a lot of doubts on the future. So all that we will come to know. But you know, before we go there, my question to our clients is, let's look at the why. Start with the why. Why have you come here today? You know, you have come here to get some updates, some knowledge, some investment strategies. But before that, why do you invest? You know, that is very important to put things in perspective. At Karvy Private Wealth, we have defined our corporate mission as helping our clients achieve their dreams and goals. And that, to my mind, is the why. We have to go somewhere in our life. We have to achieve something in life. And for that, we need to have the financial path. And that is where we come in. We look at three vectors, SLR, safety, liquidity, returns, and we try to optimize that so that we partner you towards your journey. It is famously said that customer is the king, and that is just a statement. But a lot of you would be playing chess, and I play chess, and that's the example I like to give. In chess, the king has to be first of all protected. So our job is to first protect your capital, especially in the post-COVID world. And then the king has to be taken on the path towards victory. And that is what we do. We are taking our customers on the path towards victory. And that is our role. COVID-19 and the new normal have become very, very multi-use terms now. And people call this a black swan event. I go to Sanskrit, and there's this phrase called "No bhuto na bhavishyati." What happened in the past may not, hopefully, may not happen in the future, and that's what the event is. So before we actually go into the knowledge session, I just wanted to humbly submit to you. We have thought about a 4R framework, 4R framework of investing in the post-COVID world, post-lockdown world. And that is something I request you to look at. First R is review and rebalance. Now is the time to take stock. Review your investments portfolio, also review your protection portfolio, review your estate planning portfolio, write that will which you haven't written, buy that life insurance, buy the critical care insurance, look at asset allocation, and look at rebalancing your portfolio. That's the first R. Second R is risk and return. People possibly have got their expectations down. I have a friend who is a client, he's there on the call. He is a very, very successful person. And Navneet, he actually called me and asked me, who is that person who said mutual fund sahi hai? And I said, I also believe mutual fund sahi hai. We always say that past performance in the mutual fund is no indicator of future return. And if the past performance is not as good as the expectations, so also the future returns may not be in line with the past. So it's important to look at how much risk I will take, how much return. It's now about return of capital than return on capital. Third R is more in terms of your wealth manager, your fund manager. It stands for relationship. When we are sitting at home in the lockdown, our relationships have come very close to us. While we are looking at technology for transacting, I think trust is very important. So your wealth manager, your fund manager whom you trust, that relationship is something you go back to. And the final R is rebound. Everything rebounds. That's the natural law, whether it is the economy, the industry, the stock market, whether it is the confidence index, whether it is just our life, it will rebound. So these 4 R's are something that we speak about. Review and rebalance, risk and return, relationship and rebound. India is now a land of jumlas, and that's why I'm going to take the liberty of using one more. Today's topic is a very interesting topic. It can be a difficult topic, but Navneet actually puts everything so simply that he will convert the entire difficult part into a very simple part, because it's a very important topic. So what we have done is, today we are talking about macroeconomy and the credit market scenario. As I said, Navneet is an expert. You are our clients. It is our job to simplify, and it's our job to advise you. So we have actually made a full form of credit for today's event. And that is something I would like you to look at, not just for the event, but also for the future investment that you look at, because this event is going to hopefully give you some inputs for investments. So CREDIT. C is for capital preservation. Return of capital rather than return on capital. R, we have discussed earlier, risk and return. The question is, how much is too much? Too much risk, too much return. That is the balance you have to find out. And E, now this is a very interesting thing. I saw that after 1979, for the first time, Indian GDP has had negative growth. For the first time from 1979, US has gone down by, I think, 36%, and India might go down by 9-10%. Negative GDP, E for economy, E for earnings. Earnings have bottomed out. What next? So that is something you should look forward to. Now, D is something, it's normally used in financial management, but for your own asset allocation, D is debt to equity ratio. Your own, so suppose you want to reach 100 and your portfolio is going to give you 10%. To reach 100, you need 12%. Your debt has to go down, equity has to go up. Alternatively, you have to take your 100 goal to 90. So what's your debt equity asset allocation? I is basic interest rate. We have senior clients here. You might remember fixed deposits in 1996. I remember Kotak Mahindra Finance used to give 18% returns. Today it is 5%. Home loans 2007-8 used to be 6.7%. We are back there. So the interest rate cycles, but this is now the new world. Interest rates have gone down. Will they remain down? That is something we'll have to look forward to. And finally, as an investor, the T stands for tax. You invest in stocks, you invest in bonds, you invest in mutual funds, PMS, private fund, insurance. What is your return post-tax? For example, today we have a lot of clients investing in 5.5% traditional insurance plan because it's tax-free. C for capital preservation, R for risk and return, E for earnings and economy, D for debt equity ratio asset allocation, I for interest rate, and T for tax adjusted return. That is where I leave it to the expert Navneet and invite him. And I look forward to learning a lot today, Navneet, and so do our clients. Thank you so much once again for joining us.
My pleasure. Thank you so much, Abhijit, for setting that context and background. And I really like the acronyms. Interestingly, as a house, we also talk a lot about SLR. And over the last few years have been very interesting in the credit markets with so many mishaps, and we could navigate pretty well for our clients, for people like you, simply because we always believed strongly in SLR, that safety, liquidity, and then return. And in my experience, I mean, having seen a lot of cycles and having read about so many cycles before I started working in markets, that, I mean, if you focus on safety, liquidity, returns will take care of themselves over a period of time. Rather than if you start chasing returns at the cost of safety and liquidity, then you pay a bigger price over a longer period. Interestingly, on that couple of hours, it so happened in one of my interview, and there was this question about the large cap versus small cap, and how are you looking at stocks? I said, we are not looking at the size of physical assets of that a company has got, whether it's a large cap or a mid cap or a small cap. What we are looking at in a company, whether we are investing as an equity investor or as a credit investor at this point in time, when there are so many disruptions. So it just so happened that I said resilience. They have to have a fortified balance sheet. They need to have a good liquidity position. So they must have the resilience that they can survive this crisis. Then I said they should have a very strong risk management, because as you said that, na bhuto na bhavishyati. Interestingly, in last 20 years, right from when the millennium began, right from the tech bust in 2000 to 9/11 to global financial crisis or demon or Brexit, I mean, every 1 or 2 years, you have an you have an event which is like na bhuto na bhavishyati, aisa to kabhi nahi hua, and that happened. So we have that on a very frequent basis. So you have to keep that in mind. So whether your risk management can take care of unknown unknowns, whether it can take care of known unknowns, and of course the known knowns. How do you build the flexibility? How do you look at newer risk like cybersecurity, for example, today going forward? There's going to be a bigger virus to deal with compared to what we are dealing with today. How do you look at your resources, which is particularly the human resources, reskilling your employees? I think taking care of them is going to be very, very important. R&D and innovation is going to be very important, because there is going to be creative destruction. Only the best guys would survive. So that is also very, very critical. And of course, the relationship, the way a company deals with its suppliers, its customers, its shareholders, lenders, employees, local community, government, society, everybody, that's going to be very, very critical. So it so happened then later on, I thought, yeah, there are a couple of these R's which are very, very critical. So thanks for that. Now coming to the markets and the economy, there are two ways to look at it. A lot of people, I mean, the question that I get asked by clients all the time is why there is such a big disconnect between the ground reality and what we are seeing in the market. But the ground reality, you can look at it in a two manner. One can say that now India has got 10% of the global cases are in India. India is seeing one of the fastest ramp up. In fact, cases are doubling like every 20 days. They were doubling like in the US at a pace of like 40 days. I think we have added around 5 odd lakh cases in last 11, 12 days. I mean, there's one picture of that. The another picture to look at it is there are 3 states in India which account for 2/3 of the cases. There are 200 districts in India where there are less than 50 cases or hardly any death. The fatality rate is one of the lowest in the world, if not the lowest. Recovery rate is improving very fast. There are antibodies which seem to have got developed among the young people when we are looking at the urban cities where the crisis was more acute earlier. So look at Mumbai, Delhi, I think the number of cases are far lower now. Of course, one of the challenges is that it seemed to be spreading more in the tier 2 and 3 town. But my view is that I think we have moved from a phase where survival was the main thing in the public discourse. Now I think the focus has clearly shifted to revival also. And I've been writing about it right since, I would say, from the month of April onwards, that the public discourse would start moving from survival only to revival also, because lockdown was resulting in a lot of other challenges. Lockdown was very critical in the first phase. India had one of the most stringent one. We had certain advantages because of that. Of course, the economic damage was a little larger than some of the other countries. But now we have learned to live with it, and hopefully, I think it's over a period of time, we are going to see a gradual reopening of the economy. When we look at a lot of high frequency data, because I mean today, if we have to monitor the opening up of the economy, and again, I mean, it's a mixed picture and the way you look at it. So we look at e-way bills, we look at the transportation, toll data, electricity, website traffic of what people are consuming or are viewing, vehicle registrations, I mean the diesel petrol consumption, TV ads, currency in circulation. A lot of these data are available on a frequent basis. Again, there is a bit of a mixed picture. There are a lot of these parameters which are showing consistent signs of improvement. Somewhere where there was a bit of pent-up demand, we saw a huge improvement in June and early July. Now there is a bit of plateauing out. But I mean, so whether glass is half full or half empty, I think depending on how are you looking at it. India is like a continent. I mean, it's very, very difficult to really look at it by looking at just one anecdote or one point of data. My view is that from here on, the society or individuals or communities or businesses will have to play a bigger role in how do we deal with crisis, rather than the government alone announcing that this is how we are going to do lockdown. They are still doing it at a local or state level. But over a period of time, I think the society or citizens or businesses will start playing a bigger role. How do we learn to live with it in this? Now, very briefly, and I'll just take 2-3 minutes and come to the few minutes and then come to the credit market specifically. Particularly on the equity side, because that's kind of, a lot of people ask me why markets are doing so well when the ground reality is showing something different. Abhijit, you talked about we are going to have the biggest recession in the history of the world in 2020. I mean, right from US to almost every country in the world, 200 countries will see a decline in per capita GDP, which the humanity has never seen something like that. In India, we are going to have the first recession. But the fact is, in the last quarter, Nifty had the best year in 11 years. Mid-caps had the best year in 6 years. S&P had the best year in last 2 decades, in last 20 years. So one, of course, because the crash was so sharp, valuations became cheap, and obviously a lot of stocks were looking good. Markets have learned to live with it. So when there were 500 cases in India, Nifty was 8,000 because you were so fearful about it. And now at lakhs of cases, Nifty is at 11,000 because you know that we have learned learning to live with it. So expectations versus reality, the point that you also made earlier. There's faith in human ingenuity that vaccine or antibody or medication, something will positive will happen. There's a massive new thing happening, which is very similar to, in fact, later on, if we have time, I can talk more about it. I see a lot of parallel with what we saw in 1999 with the what is so-called the Robin Hood effect. In those days in US, you had these E-Trade and, the Charles Schwab and Ameritrade and all. Now you have this Robin Hood, and in India also similar thing where the retail interest is just unprecedented. And of course, it can go on because over the last couple of months, we have seen huge number of new retail investors coming into the market. That has also played a role. But the most important reason why not only the equity market, but equity markets are doing well, bond markets are doing well, and gold is also going up. I mean, the correlation is such that if the risk assets are doing well, then risk off assets, or let's say the safe haven should not do well together. I mean, how can equity markets up, bond prices up, and the gold up? How can that all three happen? So it clearly shows the role liquidity is playing in this rally in the financial markets globally, the amount of money that has been pumped in. And the big difference between the quantitative easing that we have seen earlier versus this time is one big difference, that thanks to also the fiscal stimulus, thanks to the magnitude of money pumped in a very, very short period of time, relative to even the earlier crisis in 2008 or some of the other time. And also the other fiscal measures like guarantees, etc. The money supply growth has also gone up. It is not only the M1, because earlier what used to happen, central bank prints money, but the banks put that money back in the central bank and the reserves go up. And the banks were cleaning up the balance sheet. This time, the M2 growth is going up. So just to give you a perspective, in US, M2 growth rate is at 24%. This is the highest since 1960. In India, it is like crossing 12%. And to put in a perspective, so we were growing at 8, 9, 10%, the money supply growth, when the GDP, the nominal GDP was also growing at, let's say, 9, 10%. Today, you have a nominal GDP which is declining, and the M2 growth, which is like 12%, you are basically pumping in so much of money relative to the activity in the economy. And that's finding ways into the asset prices. And that has led to, I mean, one of the big reasons, and of course, markets are forward looking, while the data or the anecdotal evidence, what we are looking at is today, markets are indicating that better days are ahead. And there is something called, I used to be a big fan of George Soros, and he has this theory of reflexivity, that it is not only fundamentals that drive prices. Sometimes prices also drive fundamentals. If equity markets keep going up, and we are seeing in India, like almost every bank is raising capital. There is a lot of other capital being raised by some of the other promoters. If a lot of capital raise happens, both in equity and debt, that can actually also improve the fundamentals in a way that financial stability will be greater. People will be able to raise money, will be able to fortify their balance sheet better, and so on and so forth. The another aspect is put yourself in the shoes of a pension fund. I mean, of course, every client or every the person who's there on the call is dealing with the same issue. So typical pension fund or endowment fund have what is called a 60-40. 60% in equity, 40% in fixed income. I mean, the bond gives you preservation of capital, bond gives you income. 60% equity is volatile, but over a period of time gives you better return. Now the 40% is earning close to zero. So then how do you rebalance this entire thing? Is basically to have more money in the equity, because most of these pension funds, endowment funds, etc. have return expectations of at least 6, 7, 8%. I'm talking of the developed market, and people are going to face a similar issue even in India, the pace at which rates are going down. So then you have to increase the equity allocation or the other high risk asset allocation. And that's where I think credit is looking very, very interesting. Very briefly about India macro. So before getting into this crisis, Abhijit, as you said, that when I came to your office to meet all of you, I was thinking that we have gone through a lot of challenges in last 6 or 7 quarters as an economy, but this would be that quarter, March quarter, where most likely things are going to bottom out. And because of all the structural reform, the pain that we have taken, I think things are going to look better from FY21 onwards. But then again, this crisis has hit us. Of course, there would be new set of challenges that are likely to emerge because of this crisis, particularly because our fiscal capacity to spend money is very limited compared to most of the other countries in the world. And we had certain challenges in our financial sector before getting into this crisis. But again, those challenges in the financial sectors are going to throw a very, very interesting opportunities. I mean, I always look at both sides of every crisis, and then there are always opportunities from every crisis. I'll come to that in a 2 or 3 minutes time. There are a couple of positives for India in all of this, and I've been talking about it for last 3 or 4 months, even when people were extremely worried about this crisis. The external balance sheet of India is very, very strong, and you have people from Middle East also, I'm sure they've been watching it. The our FX reserves at over $500 billion. Remember 2013 when the FCNR, the deposits have to be bring in to kind of save from a BOP crisis from $260 billion to now close to 520. We have doubled in last 7 years, when almost every emerging market I can think of has lost foreign exchange reserves. India is in a different league altogether. So that gives a lot of strength to the country. Rural economy has been doing well. This could be a Y2K movement for India, and we have seen that in electronics, chemicals, some of the sectors, there are clear positives about it. Digital economy, it's a big opportunity for India. I call it a Y2K movement for India. If data is the new oil, then India is the country which will be leading the OPEC the way Saudi Arabia leads the OPEC. If data is the new oil, then we are the ones who have the highest amount of data as a big data consumer, as well as if AI is going to be the future of the world, who's going to provide the big data? It's India. So, it's going to be a very, very interesting thing for India. And of course, in the healthcare sector, and some of these sectors have done pretty well, there's going to be another big opportunity. India is the pharmacy of the world. The last point I've been mentioning last couple of months, and reforms always happen out of compulsion, never out of conviction. And the bigger the crisis, you see bigger the reforms. Without getting into much in detail, later on, if we have time, I can talk about it. Whether what we are doing in the agriculture sector, what the state governments are doing in the land and labor laws, this whole performance-linked incentive, PLI for some of the sectors like pharma, electronics, etc., which is going to get extended for a lot of sectors. Some of these are very, very interesting reforms and will have longer-term repercussion on India. Coming to the rates and the credit market, now think about it over the last few months. Because I think we had the fiscal constraint, India didn't have the ability to do what, let's say, US has done or some of the other countries have given in terms of giving the cash handouts or the kind of money which has been thrown by the governments world over. The heavy lifting has been done by the central bank. So RBI has cut interest rates sharply. They have injected a lot of liquidity. They've announced moratorium. They've announced bit of restructuring. My expectation from tomorrow policy is that maybe there could be more relaxed, I would say, one-time restructuring. Of course, our recommendation has been that given the circumstances, we should do that. At the same time, as a country, a lot of gains have been earned in last few years on building a high, very good credit culture, both on the retail and the corporate side. That should not be compromised with. But within that, the need of the hour is that we may have to allow a bit of restructuring, which is likely to happen. And one of the positive for RBI, and they could increase the size of their balance sheet, was what I talked about, the forex flows. We have got $100 billion of foreign exchange flows in last, let's say, RBI has added reserves or RBI has bought the dollars to that extent in last 18 to 24 months. And that has resulted in a significant expansion in the balance sheet of RBI. So RBI's balance sheet today is almost 27% of GDP. Now, this number last time we saw was in 2007 or so, where we had a huge foreign exchange flows coming into the country. Now, that liquidity is surely helping us with some of these MSME guarantees and some of the other measures, TLTRO, etc. The rate curve has come down. But still, the 10-year yield, if you look at the bond yields today, they are not where they were in some of the previous cycles. So as Abhijit talked about earlier, we are going to have the biggest recession in 1979. But the 10-year bond yield is more closer to 6% when you compare with some of the previous slowdown. In the month of January 2009, the 10-year bond was at 5%. In fact, for a day or so, it was below 5%. In 2003-04, we saw the 10-year yield at 5% or so and staying there for like a couple of months. This time we are slightly higher, mainly because of the fiscal constraint that we have. But I think RBI's intention is to bring down these term premiums. And RBI over the last few months has tried very hard, at least the front end of the curve. Look at the 3-month treasury bill, they are at 3/4. You look at 1-year treasury bill, they are like at 3.30, 40, 50. So you have the entire short-term curve between 3/4, 3.5%. And of course, the curve is steep. But I think RBI's intention would be tomorrow, and we are looking forward to what the governor says tomorrow, is how do we bring down these term premiums? I don't think RBI should do more rate cuts. Honestly, they should keep some powder dry. At this point in time, credit demand is limited. and they should keep the powder dry for a time when the credit growth improves. At this point in time, they should try to ensure that liquidity is ample, liquidity is abundant in the banking system, and how do we bring down the long-term rates even more from where they are today. The curve is already steep. You have the reverse repo rate at 3.35, where banks are giving lakhs of crores to RBI every day, and you have the bond yields higher. Then I think it's better. How do we bring down that term premium? And the other thing I'm sure RBI will try, with also government is trying, how do we bring down the credit spreads? Today, look at the way curve is, and the best way to explain is to look at the current yield of our various portfolios. So we have our liquid fund or overnight fund, where you have a current yield of like 3/4 or so. You have these low duration fund, I think slightly closer to 4%, corporate bond fund, banking PSU fund, short-term fund around 5%. Then you have these medium-term income fund would be like between 6 to 7, and the credit risk above 7. I mean, curve is quite steep. But I think that there is huge amount of opportunity to me is in the overall credit markets. And I'll just take maybe 5-7 minutes to explain why I strongly believe in that at this point in time. I've talked about the equity markets, why they have gone up. I mean, I can discuss later on if you have interest in gold and some of the other asset classes. But I always look at capital cycle. People look at economic cycle, people look at business cycle, people look at profit cycle, people look at credit cycle. I look at capital cycle, where the capital is moving. And I think that gives you a very good, I would say, a sense of which asset classes are getting overpriced or underpriced compared to the fundamentals. This, I mean, I'll take 2, 3, 4 minutes to set the background why I believe in that. So I believe in something called the Minsky movement. Hyman Minsky was a very famous, not so famous economist for a very long time, but suddenly got discovered in 2008 that there are these kind of cycles in financial markets, starting with what is called a displacement. People think there is a new paradigm. There is something has changed forever. Rates are going to remain low, or rates are going to rise from here. This is a new technology, and that's why you could justify Cisco at any price in 99, or you could justify an infra or real estate company in 2008, or you could justify an NBFC 2 years back. And then this leads to this new theory leads to a lot of capital starts moving in that sector or in that theme, and that creates a boom. Then it creates a euphoria where, I mean, you can't find anything wrong with that. And as I said earlier, it is not only the fundamentals that drive prices, prices also drive fundamentals. Then you have a profit taking, because some of the smart investors think that there is something wrong which is happening. I can't see the connect between the fundamentals and the prices of these securities where they are trading. They start doing a profit taking. The investors have already bought enough of it, and that's where the panic sets in, and that sector or the market starts falling. And financial markets have their own self-correcting boom and bust cycles. They go from boom, they go to bust, and you cannot stop it. Regulators can try a little bit, but they have their own self-correcting mechanism. They have their own self-fulfilling mechanism, going from displacement to boom to euphoria to profit taking to the panic. And when I see last, like let's say 2 years or so, you had a post-demand period where, you know, the money was ample, money was very easily available. Banks got so much of deposit, very few borrowers. NBFCs were a willing borrower. And just to give you one data point, I think it was FY 18 or 19 where bank credit to NBFC was more than what they did in the previous 3 years, one single year. Mutual fund AUM doubled on the debt side, and everybody was giving like money to the NBFCs, and the exposure almost doubled from 2.5 lakh crore to, I think at peak like 4.5 lakh crore or so. Because equity markets were doing well, they were giving good results. Everybody was, from the equity prices were going up. You get more money in equity, you get more money from the debt investors, and then you make more money because, I mean, money is easily available. And then you get better rating. As you get better rating, money becomes cheaper to you, profits margins go up, and then you get into the cycle. And then the ILFS happened. And then we have seen a reversal complete reversal in the last 2 years. I'm giving you this example to make that point very, very clear. And see from what extreme we have come to another extreme with the series of events that were happening. So you had a big NPA cycle starting from the PSU banks between 2013-14 to let's say 17-18, where PSU banks went through a big, I would say, an NPA cycle, and then they became very conservative. The space was taken by some of the private sector banks like Yes Bank, and then these NBFCs, HFCs. They have gone through a very, very big trouble. Some of the development financial institutions, or let's say the ILFS, etc., they have gone into the trouble. You had some of the mutual funds who also started playing kind of that role, but I think it was not supposed to be played like that. So, I mean, you had a T+1 liability, and you had some of those structured papers that some of the funds were doing. And now again, you had a big bust in a credit fund. I mean, the fund had to shut down, and you have seen a complete change in investors' mindset. For several years, the most favored asset class was like, one of the most favored asset class was a credit. It was sold in the name of accrual by funds, which is doing so well. It was sold by NBFCs in a different manner, by the private banks in a different manner. But I think credit today is like absolutely a word which nobody wants to touch. And as I told you that, as Abhijit mentioned about all of those credit, and like look at whether the tax aspect, where the interest rates are, where the economy is going, where the earnings are going. In all of that, when I look at, and I find that which is that asset class where there is going to be biggest disconnect between the reality and what you are getting paid for or you're getting compensated for. So let's say if you're putting money in a corporate bond fund or in a short-term fund or anywhere where the current yields are now below 5%, over the next 3 or 4 years, 5 years, you're going to make, let's say 20-25 rupees. And you're taking a bit of duration risk, but of course, if the money is for 3, 4, 5 years, I mean, that's the amount of money you are going to make. Rates have to fall substantially for you to make more than 4% or so. But of course, over a 3 or 5 year period, if you get capital gains, which are front loaded, then current yield will fall even more. And then your overall returns are unlikely to be going to be more than 4.5% per annum. And then you look at another set where large number of these lenders, whether it's the public sector banks or after the Yes Bank fiasco, let's say the private sector banks or these NBFCs, HFCs, the business model is going to be very different, or the credit funds the way they were doing. India is such a large economy. In a $3 trillion economy, I mean, the amount of need for credit is so large, it's so large. I think that's where there is a very, very big opportunity, but it has to be done very differently. The biggest challenges in the credit markets are what I call several mismatches. Starting with the biggest mismatch is like asset liability, and that's why the problem comes. You have a T+1 liability in a fund, in a mutual fund, and then you try to do illiquid asset. Or you are an NBFC borrowing money in a 2 or 3 month commercial paper in wholesale market, and then trying to do the structured paper, so on and so forth. I mean, even the private banks had the same problem. Mismatch of expectations. What do you think about that asset class and what the what that asset class is? Mismatch in incentives, or the misalignment of the between the manager and the investor. The mismatch of skill set. This is a highly specialized skill set, and that's why if you look at US, over the last 25, 30 years, the people like Oaktree and Apollo and all of these guys, Blackstone and all, and I can give you very interesting examples of how they take advantage of some of these cycles, and a big money is made, Seth Klarman and all. I mean, you can read their books, and I'm sure the memos, etc. Because the information asymmetry is higher, they are so-called illiquid asset classes. And I always say this, illiquidity is one of the biggest source of alpha. Because they are illiquid, a lot of people don't look at that. And now there are such interesting opportunity. I strongly believe over the next couple of quarters that a large part of the system, which was a supplier of credit, will be cautious. But on the other side, when you reduce the flow of the capital, a lot of discipline come on the other side, and then you get a real good pricing power, and you get compensated for the risk that you are taking. And one of the mismatch, I talked about a couple of those mismatches, was in the contract design. And now with the IBC and NCLT structure, etc., I think your ability to recover money, that even if you have a higher, let's say, I mean, whatever is the probability of default, earlier it was very difficult to calculate what will be the loss given default or what will be the recovery. Now I think it's a lot different with that entire ecosystem that has come in place. So if you have a patient capital, for a couple of years, if you have the right kind of skill set, if you have people who interests are completely aligned with the interest of the investors, you look at the right universe, you manage the risk rightly. I think that's where I believe over the next couple of quarters, the biggest opportunity in India is going to be. I have a lot of other views on global economy, on domestic economy, on whatever bond market, equity market, depending on your interest. Would be happy to take those questions. But I wanted to highlight this specifically because I think that's where, because people are so cautious about it for the right reasons. There is so much of uncertainty on this health crisis. There's so much of uncertainty on the economy. There's so much of uncertainty on the effectiveness of the stimulus. So, I mean, people are right in terms of having that cautious view, but that's where the big opportunities that get created. So maybe on that note, I would be happy to take any questions.
Thanks for a wonderful session. I think many insights, a different way of looking at things, and I think lots of learnings for everyone over here. Of course, one of the questions which is coming through and through and which has been actually talked about, and I think the first question over here, I think all the three questions which are coming up are about the loan moratorium. And do you see more pain over there? Do we really look forward to, are we going to improve from here, or how are things going to plan out? So some, talk on that would be great.
No, in fact, interestingly, of course, we'll have to wait and watch. But interestingly, people have been positively surprised, whether it's the banks or NBFCs, everybody that we talk to for the last couple of weeks, people are positively surprised by the improvement in the collection efficiency. So you have seen, the data coming in by, the data that has been given by most of the banks. Results have been announced both on the moratorium 1, moratorium 2, and then how the collections have been. I think across most of the loan segments, I think things have improved substantially, and the overall morat levels. If you have looked at the results of SBI or SDFC Bank or most of the other banks and NBFCs who have announced, I think it has come quite positive because people are also realizing that from a borrower's perspective, that it doesn't make sense. If you can service your loan, it's better. Over the last couple of years, with all the improvements on the overall IBC, etc. front, and particularly on the retail side with the CIBIL score, etc. I think people are very, very particular about the credit culture and not allowing their credit score to kind of get impacted. And so far, thanks to the money unleashed by the RBI, the new scheme that government came up with, that MSME, I'm sure most of the banks have praised it quite a bit, how it has helped the overall MSME sector. And MSME is such a large sector in India. In fact, that's where I see a big opportunity in India in next few years from a credit perspective, because MSMEs, which are like almost 1/3 of the economy, they are like 40-45% of the total exports in India. And government is very clear that we will do whatever it takes to kind of support them, and RBI is very clear. What I expect tomorrow from the policy is not another moratorium. What we expect is that a one-time restructuring. You should not try to save everybody, because there are few businesses, they may have to shut down, they may have to take a big pain. There will be a creative destruction, not that everybody can be saved, but people who were doing well till February, people who still have, I think, an ability to not only survive in this crisis, but come out stronger, but are going through a near-term challenge in the business. Let's say a classic case of a hotel business, or some of the people in the travel and tourism or transportation, etc. You have to do a bit of hand-holding because the revenues are zero. They have a cost structure. You have to probably give them a bit of restructuring, but with certain, some of the, I would hesitant to add that, like banks may have to put some upfront provisioning, so that it should not become very easy for bank to do an SDR and CDR, what used to happen earlier. They have to put an upfront capital or an upfront provisioning if they are doing a restructuring. And then with fair amount of, I would say, checks and balances, that is something that I'm expecting tomorrow. Not another moratorium. Nobody is asking for it.
Thanks. You gave a very beautiful analogy in terms of capital cycles and how it moves. And I think that's quite interesting. And India, when we talk about, we have almost within Nifty, we have almost 40% market cap comes from BFSI segment, and it is probably hit the most. And one of the questions over here was also about the banking sector. So where do you actually see this credit growth coming from? Particularly because the big corporates, of course, which used to be the favorites earlier, are now not. And of course, you've talked about MSME. So if you could just give more insight into that, that will be a very good thing which people are looking forward to in terms of understanding.
So overall growth in credit is likely to remain muted. RBI has unleashed so much of liquidity, but still from the other side also, when let's say what Abhijit was talking about earlier, that you are yet to reach 100% of the size of the GDP what it was in January. That will happen in like 2000, maybe some point in time in 2021. So the overall need for credit itself is going to be limited. But of course, in a $2.5–3 trillion economy, as the economy comes back, we may not have a strong V-shaped recovery, but highly likely that we have a strong U-shaped, stronger rebound. A little bit of slowdown for a few quarters, and then you have a good rebound in the overall activity on a smaller base. Then there would be credit demand from almost all segments. In last few years, bulk of the credit growth, a good part of credit growth has happened in the household balance sheet. People have been leveraging, to buy whether a consumer durable or whatever. I think that growth is likely to be a little slower. And my sense is that, government, financial sector, everybody would love to see a higher leverage by the productive corporate sector.
Sure, thanks.
Even on the real estate, I have a highly contrarian view than most of the other people. People are extremely bearish on real estate. I think prices are likely to correct, no doubt about it, because the demand has collapsed. Every builder or every construction company would have a very, very difficult time in terms of their cash flow. So prices will correct. Over the last few years, particularly in places like Mumbai, rental yields have gone up. Now, if you compare the rental yield versus the EMI yield, Abhijit was talking about, now we are seeing 6.5–7% or below 7% on the housing loan versus, let's say, 3–4% of rental yield. The difference is much lower. Or you also compare that if I live in a rental house and put that money in a fixed income fund, I'm going to earn 3–4%. And that too, look at the overall tax aspect of it. Then people may be better off buying a house and spending a couple of months in the house, and then at this point in time when people look to change their house because the school season, etc., and suddenly they are finding it so tough, there'll be an innate desire to have their own house. And I actually expect a recovery in demand with prices settling lower, affordability increasing in terms of EMI. The difference between the interest rates and the rental yield and the EMI, if I look at all the three interest rates, I think overall I won't be surprised. So there is going to be demand for mortgages as well.
Sure. Now, next question, one of the few questions which are asked over here are, about what should be the debt equity ratio and other things. So I think this more towards Abhijit. So I'll probably rephrase that and put it, what should be an ideal asset allocation? And from in your thoughts, Abhijit, for
actually, before I go to that question, something that Naveen said, survival to revival. I think that's a very nice theme. That's a very nice thought process. So one is no longer looking at just surviving, but obviously coming back and getting something which will help them achieve their goals. The other point Naveen mentioned about real estate, actually at Karvy Private Wealth, we have the same view. We are also positive on real estate. The population of Mumbai is same as the population of Australia. So where is the space left? And it will only grow up. So that's a very unique and positive call where we both agree. Coming to asset allocation, if you just keep things simple, we had normally said that equity is equal to 100 minus the age. In terms of keeping it very, very simple, asset allocation can be made very complicated. Today we are saying that in my portfolio, equity should be 105 minus my age. So we are equity overweight. But if you look at it technically, we have risk profiles and we have aggressive, moderate, and conservative. So if somebody is an aggressive investor, normally we say 70% should be in equity. Today, the tactical allocation is 75%. But even within that equity allocation, we are seeing majority should be large cap. well-run companies, good corporate governance, sustainable models, good cash flow. So 65% should be in large cap, 25% in mid cap, 10% in small cap. In terms of debt, completely agree with what Navneet was saying. So a credit call is only for a really aggressive investor. Otherwise, it's simple. You do bonds, you do AAA corporate paper, high credit quality, PSU debt. Somebody wants to go slightly higher, they can look at higher yield kind of debt. In terms of gold, gold prices have gone to sky high levels, but still we believe gold is a good hedge in the portfolio. So about 5 to 8% should be gold. So majority equity will depend on the risk profile, on the age, but whatever normally you would do with the bottoming out, we are saying should be slightly higher than that. Shantanu.
So thanks Abhijit. One other question, what people are asking over here is more about the markets. Do you think there's more steam left in the markets, and especially a lot of questions around the banking sector? That do you think that the banking sector still, because it's down as of now, and will it perform? How is it going to pan out over maybe next 2, 3, 4 years? From an investment opportunity perspective?
See, when we look at the overall economy, where let's say in a global economy, there is going to be a $5 trillion of loss of output this year. I mean, the global economy, if you look at the size versus the, let's say, degrowth of 4-5%, or I mean, in terms of nominal, you add the inflation and then look at the overall output loss, even in India, who's going to take that loss? A part of it will be compensated by the government. They have printed more money, but at some point in time, somebody has to pay those bills. Part of it, whether individuals will take it at some point in time, you'll have to pay that back in terms of higher taxes, whether it will go to the financial sector, part of those losses. I mean, there are going to be challenges in the economy, and then it will get distributed to various people in various forms. Whether we are going to have higher inflation because the government debt will go up so much, so whether indirectly everybody is going to pay that price of these losses in some or the other form, and whether they are going to front load it or they are going to back load it, and who's going to take those. Financial sector, clearly, because I mean the leverage is a double-edged sword. In good times, the returns get magnified. In bad times, obviously, I mean, even if a slight increase in the credit cost lead to like a significant fall in your profit or even, a drawdown from your capital, which is what the market's worries are. Because given the uncertainty on the horizon, I mean, we have seen 1 or 2 moratoriums. As of now, the losses are not on the book, but what kind of credit loss is going to be on the book? Interesting part is that because of this liquidity, equity markets doing well, we are going to see big capital raises by almost all the players. We have seen, I mean, some of the big capital raised by the banks. We are going to see that on NBFCs. We are going to see that a lot more over the next few months. So balance sheets will get a lot more fortified. This will have impact on the near-term return on equity, because what is ROE? Is return on assets into your leverage. If the capital is more, the leverage has come down, it will impact your ROE, which in turn will impact your price to book ratio that you pay as an investor. So while the balance sheets will get fortified, the probability of survival will go up, but then the return of equity will come down. So valuations may not go back to where they were before March or February. It will take some more time for the financials to reach there, which we have clearly seen in the market. The another way to look at it is structurally, I mean, the longer term positive factors for the financial sectors in India, given the low penetration, digitalization, financialization, formalization of the economy, remain very, very much intact. There's going to be more consolidation. The survivors will actually do extremely well, and you need to bet on those players.
One more thing is that, of course, we've witnessed very low returns in the past decade or so, both on debt and, of course, equities also have not delivered a very high return over there. Now, keeping that into perspective, if we were to, any debt investor, how do they reset their expectations now, or do they expect something more out of it in coming times?
So I would say that rather than looking at in absolute terms, you have to see in the absolute terms. When people say that debt has not done well because you were making 8-9% when inflation was 8-9%. In fact, inflation was almost double digit for some time in 2012-13, and you were making 8-9%. Now, even those 4-5 returns, of course, CPI has gone up to 6% or so, but we are in a deflation. I mean, we are in a recession. So in a real terms, actually the returns are higher than where they were. Over the last 5 years, particularly, the real returns have been quite positive on the fixed income side. And equity, again, depending on what your starting point is and how disciplined you have been. I think for disciplined investors who have been doing continuous SIP, of course, I mean, we have gone through a bad patch, but I think those who have been disciplined, I think have done reasonably well. Where the valuations are today, I think from a global investor's perspective, I mean, look at the US S&P, you look at the bond yields globally, I mean, the returns expectations going forward have to get reset. There is going to be a period of financial repression where central banks would try to keep rates below the inflation. And definitely, I mean, you have to moderate your return expectations because all other asset classes are getting repriced accordingly. Where people are going, so people are seeing that, okay, if the currencies are going to depreciate, I don't have faith on fiat currency, central banks will print so much money, I'll buy gold. Gold doesn't earn anything. Gold is completely dependent on, I mean, on a very lighter note, I've been recommending gold for quite some time in our multi-asset allocation. We have been overweight for more than a year now. We are still over 20% in gold, but it works on a bigger fool theory that somebody else is going to pay a higher price than what you have paid for. It doesn't earn anything. That's where I think credit fits in very nicely because I think let's say we have this AIF where we are looking at SME, MSME opportunity on the credit side with some bit of upside optionality on the equity through restructuring. I mean, there is a possibility you make 18-20% there, and at least at a deal level over a period of time. I mean, when I compare that with where the bond yields are, where gold is, where equity valuations are, and I find that on a risk-adjusted far better than the other opportunities I'm looking at. And you look at the collateral, you look at the covenants, you look at that business, you look at what promoter is giving you, including a pledge on his house and every single thing or her house. I mean, you find those opportunities very, very interesting. And nobody's looking at it because everybody's so cautious on that segment.
Interestingly, you spoke about it. And in fact, my next question was about to go about your AIF and the credit risk fund which you run. Because, in this low rate of interest scenario, and what we've seen is your fund has consistently given, the payback in terms of whatever coupons is not through a difficult phase also been able to manage the monies. So my question about that is while the opportunity is in the MSME segment, we've seen good amount of credit risk funds which were there earlier. And from a capital cycle perspective, it looks attractive because at that point in time, a lot of money was chasing high yield, but there were lesser opportunities. I think today, as you rightly said, opportunities are more and lesser money chasing that. So that ways, I think that falls into perspective. But if you could give more insight, because, investors have been asking this question that, debt is giving lower yield. Equity is, of course, also not yielded it's also all-time high. So this becomes an interesting space from an investor's perspective. So how do you manage that? How does the risk get managed? Though it's a long-term, for a UHNI kind of a product, but at the same point in time, how do you mitigate the risk? How do you feel that, we will be able to do better and not fall into the trap earlier? And of course, you have a stellar track record, but of not falling into any kind of crisis, but still on that.
I think it's the right alignment, which I said. I mean, the challenge is that what we have seen in the credit markets history suggests that whether you go back in 90s, whether you look at later, whether you look at the development financial institutions to the PSU banks, the cycle in 90s, early 2000, or you look at the later, look at the NBFC, again and again, the same cycle. What we have seen in the credit funds recently. In fact, I mean, a similar situation happened in late 90s, early 2000 in the mutual funds earlier on the credit side. All of them are very, very similar because there is a misalignment in terms of the way the deals get structured, in terms of expectations versus reality, in terms of the skill set, the kind of skill set which is required, the incentives the way they have to be. So when you are like continuously, just to give an example of, let's say, a T+1 liability credit risk fund, which grew from like 10-20,000 crores to like 1 lakh crore, and continuously you have to deploy that money. And then you have to go down the credit curve because in the competition, returns are coming down, you have to deliver higher returns. You don't look at your liability side, that this is T+1 and you're buying illiquid assets on the other side, and then you're not getting compensated enough for that. Similarly, I think the challenges that NBFCs, which were growing at 25-30%, or the private sector, that bank that got into trouble growing so fast. Here, what you are doing is that, I mean, out of 100 deals that you look at, you just do 1 or 2 of them. I think you kind of filter the deals because you have the luxury of deploying the money, the time, or the pricing, or the right kind of terms that you want to do it. You don't draw down exactly, I mean, the 100% of the money at the time of investment in that fund. The investor pays, I mean, gives the money as and when the deal is done. The way kind of the entire deal gets structured, I mean, you look at the cash flows, you look at the business which is generating EBITDA, whether the business is going through a small challenge in terms of mismatch in their cash flows at that point in time, or a mismatch in a little bit of capital structure that you try to correct. How do you ensure that your interests are completely aligned with the borrower's interest? Because you're trying to make those, 18 or 20 or 25%. Here you try to structure the deal in such a manner that the standard cash flow or the coupon that you are taking from the companies, let's say 12, 13, 14% from these SME, MSMEs, and the remaining returns come based on the way you structure the deal. And it's completely aligned with their cash flow, completely aligned with the company. Because the way you are structuring the deal, their interests are completely aligned with you. So alignment of interest between the investor and the manager, between the manager and the end borrower, and the entire ecosystem. It is a highly specialized skill set. I mean, credit is a highly specialized skill set, which is always scarce, and that's why you get compensated very well if you try to ensure that the incentives are properly aligned, and then you manage the risk very, very well. And you're not in a hurry to really build the size, but build the fund over a period of time.
So one more point, I think it will be interesting to hear your thoughts on that is, we see there's been a lot of noise about the US and China relations and production moving out of China. There's a good amount of opportunity which lies over there for India to pounce on. And there are talks about some, production shifting into India, of course. How does an investor benefit out of it by investing into which kind of funds? How do they can get some, benefit out of it in some way?
So I talked about it briefly. I mean, the whole supply chain shifting, where the world is looking at reliability of supply chain rather than trying to optimize the supply chain, which has been the case for last 20, 30 years. Now, what people have gone through in last 3 or 4 months, I think there is clear shift towards reliability more than the optimization. At the same time, increasingly, there is a lot of animosity towards China, and almost every country is looking at alternates. And India is clearly emerging as one of the favorite destination, simply because we have a large domestic market also. Also, like all the measures that have been taken over the last couple of years, including the recent decrease in the corporate tax rate, removal of the dividend distribution tax, a significant improvement in the ease of doing business, so on and so forth. And now you have a lot of things. In fact, in the interest of time, I won't go deeper into it, but what the government is doing from our interaction, they're trying to create a land aggregation. We're trying to create industrial clusters for identifying some of the industries. We have seen big gains in India for electronics. I mean, just give you one data point. Our imports of mobile phones have collapsed. We don't import mobile phones now because a large number of them are getting manufactured in India. One can say that it is more of an assembly because components or semiconductors are still coming from outside. But as we develop the ecosystem, India is one of the largest market, and particularly in terms of growth, automatically all of these companies would also look at the components manufacturing in India, and they are getting a lot of incentives, whether in the form of tariffs or the non-tariff incentives or the barriers from the government supported by them. We have seen that in chemicals, we have seen them in the electronics, we are seeing them, we are going to see them a lot of in industrial goods, in auto ancillaries, in textiles, in leather, variety of industries. And then of course, as I told you earlier, healthcare and IT with virtualization of processes. So across industries, there are a lot of interesting opportunities.
So one question I'd like, last question, and probably try and put because paucity of time. And this is a question which I'd like to put to both of you. So same question. I think I'd like to hear both your thoughts. So Abhijit, first with you that during the present scenario and the current volatility, a lot of questions are around. People are seeking advice. So what is your message to the investors?
Okay, so two, three things. One is actually I go back to what we both said in the beginning. Investment is both easy and difficult. Any return of more than the bank FD rate carries a risk. So nobody will be able. I had once seen a mutual fund ad which says that we maximize returns at minimal risk. It is completely unacceptable. It's not possible. So you have to look at safety, liquidity, and returns. And the higher return you want, you'll have to compromise on safety or liquidity or both. So that is something as a basic phenomenon. Second is, a lot of investors have lost money. In North India, there's this saying that अगर मेरा मुंह दूध से जलता है, गरम दूध से, तो मैं छाछ भी फूक फूक पे पीता हूँ. That means I have to, once I get into an accident in terms of my investments, I have to be doubly careful. But at the same time, one has to be patient. One has to be positive. The most positive people in the world, you will find them in the equity market. So one has to do that. At the same time, one has to plan. And the other thing is review. There was this very old motorcycle ad which said, "Fill it, shut it, forget it." It is not possible now. You have to make the investments, trust the advisor, but you have to keep on asking, saying, you had told me it will go up by 10%, it has gone up by 5%, 6 months are gone. So keep on going back. You have to also learn to value money. I meet so many investors who fight for 1 or 2% interest rate, and then they go and lose a couple of lakhs in trading by doing F&O. So I think that is important. You have to really value the money that you have. I saw a few questions on the Q&A section. So I just wanted to say a few things there. Somebody was asking, I'm a senior citizen, what should I do in terms of FDs and bonds? I think today you can get good yields on bonds, and there are certain AA bonds, there are certain bonds which can actually give you a much higher return than a bank fixed deposit. On credit, I completely agree with Navneet. There was a time I used to work in corporate banking, and I used to lend money for ICICI Bank. And lending is not an easy task. Sometimes people will give you a rate of interest, they'll give you a high rate of interest, but they will say principal nahi milega. So that is something one has to be very careful about. So just for getting a higher rate of return, please don't take extra risk. There was a question on sovereign gold bonds. If somebody is buying gold, and I completely agree with Naveen, gold actually has got zero industrial value. Silver at least can be used somewhere in the industry. But if you're going to buy gold, paper gold, sovereign bonds will give you an interest rate beyond the gold price. But it's a long-term investment, but it's something that you should definitely look at. In terms of hedging, somebody said, I want to hedge my investments. There are possibilities, there are structured products. We can tell this to you one-to-one, but the important part is you look at your risk profile. If you can't take that risk, don't take that risk, because losing hard-earned money is really very painful. And in terms of opportunities, I believe, personally, I'm completely sold on this. I believe equity opportunity is very high. Last 10 years, returns in the equity markets have not been so good. They have been, I think, 6-7%, including mutual funds. Typically, large cap are given 5%, 6%. I believe in the law of averages. I believe in mean reversion. So I believe the next 10 years, one can actually make very high returns. So look at the asset allocation, invest money, be patient, ask questions, and keep on regularly investing. That is something I would say, Shantanu.
Thank you, Abhijit, for your views. Same question to you. Navneet, what's your message to the investors in current scenario?
When people ask us, how do you feel? And I say, we feel anxiously excited. We are anxious for what you are seeing around you. I mean, there is still a lot of uncertainty around this health crisis, the impact on the economy. I mean, the longer term implications in terms of how the behaviors will change. But at the same time, you feel excited because those are the times when you get opportunities of a lifetime, when you get big opportunities. That's where the mispricing happens, when there is good news, you don't get good prices. Good prices are only when the news is not good or news is really bad and people are worried about things. This time things become very, very cheap. I think it was this investment banker Rothschild, I mean, one of the richest family in Europe. Somebody asked him that, how you made so much of money? Why you're so wealthy? He said, I just make people happy. And that's how I made money. So by making other people happy, how do you make money? That means you are donating, and then how do you become so wealthy? He said, no, no, no. When somebody is panicking and want to sell something, I just buy. He feels happy that I just sold to me. And somebody comes like very excited that I'm not getting the security from anywhere. Can you sell it to me? I sell it to him, and he feels very happy at that point in time. And then that's how I made my money. So you have to be on the other side of the trade, and I think that's a way to make money. I mean, tough times don't last. That's the history of the world. Tough people do. And in the month of March, I used to do so many of these webinars during that big downturn in March and April, and I used to say that Dow Jones actually bottomed out much before the World War ended, much before Hiroshima, Nagasaki, or any of those times, because the Federal Reserve played the right role, and of course the markets have their own wisdom. I mean, if you think that I will invest when there is absolute clarity on the horizon, I mean, there won't be any bargains left. In fact, Howard Marks put it very nicely that when the knife stops falling, when the dust settles, when there is absolute clarity on the horizon, when the knife stops falling, when the dust settles, and when there is absolute clarity on the horizon, you can be rest assured there won't be any bargains left. So bargains are only available when there is a lot of dark clouds. And today the clouds are very dark, literally today. I mean, when I look outside my window, they are literally very dark. Nobody really knows how dark they can get from here. Nobody knows, I mean, how long they can remain dark, but one can be sure, going by the history of the world, and it's not going to be different, the dark clouds are always followed by shining sun. This time won't be any different.
Thank you so much. So just to conclude the session, I would just summarize the entire discussion. We got beautiful insights from Navneet about market cycles. Capital cycle was extremely eye-opening kind of an insight. He talked about while things are not going to be rosy, but at the same point in time, there are opportunities which are around. Interestingly, he also touched upon where the opportunities could be he spoke about the credit space, and he strongly believed that the SME is the place which is going to give the growth. Apart from that, he also mentioned about, where our economy could actually bounce back, how opportunities move. Thanks to Abhijit talked about how one could look at in terms of his asset allocation, what one should do as an investor. I think very specific answers in terms of what your allocation should look like, and an overall view on entire economy also. So Navneet, thank you so much again, last but not least, thanks to all our participants and our clients for coming, taking your precious time out and coming and listening to us. We will continue to actually share more knowledge series like this, and we will keep inviting Navneet from time to time for his views. Thanks.
Thank you. Thank you.